Hello and welcome to Young Turks, India's longest-running show for startups and entrepreneurship. I'm Shereen Bhan. For all of India's population power, consumption is still limited to just 30 million households with a per capita income of more than $15,000, consisting of roughly 120 million Indians. Now this, as per the third edition of the Indus Valley report by early-stage venture capital firm Blume Ventures. It is these 30 million households that pretty much pay all the direct taxes. That is 1.5% Indians pay India's income tax in entirety. They own all the personal cars, credit cards, make most of the mutual fund and stock market investments as well. And this Indian consumption class, while growing steadily with an appetite for premium products, the sale of entry vehicles is declining while SUVs rule the roads. And who can miss the craze for iPhones? Apple's India sales set to overtake HUL sales in FY24, but that's only half the story. The 30 million households also effectively constitute the market for most startups, signaling perhaps a saturation point. 75% of our retail spend still go towards necessities, and with per capita GDP still at about $2,500, Blume estimates that discretionary spending has only grown marginally from 21% of consumption in 1999 to 29% in 2022-23. Now, India's consumption is under-indexed in several categories, from cars and ACs to refrigerators and domestic air travel. Having said that, India's fintechs have certainly played a part in expanding the consumer class by expanding the credit market, bringing in new credit borrowers. But the quality of the borrowers market is also with its limits. Cash burn-fueled category building has taken a back step, with venture funding in India dropping to pre-2017 levels. It raises the question, have Indian startups hit their growth ceiling? Well, the Indus Valley report says it depends on where you look. It says we are seeing a wave of consumer tech startups emerge, attacking distinctly Indian use cases and monetizing via microtransactions. Digital native brands continue to do well. Quick commerce players Blinkit, Instamart and Zepto are global outliers, and distinct India-only models, be it in dating, OTT, spirituality, elder care, and most importantly, manufacturing, are the frontiers of the future. With the ads business taking off, the report emphatically concludes that Indian startups are evolving distinct playbooks for growth. Thanks very much for joining us on this special edition of Young Turks. I'm Shereen Bhan, and with me to encapsulate the exhaustive report in the next 20 minutes or so and help make sense of this study of the future of Indian startups, I'm joined by the author, Sajith Pai, partner at Blume, and also Karthik Reddy, co-founder and managing partner at Blume Ventures. Sajith and Karthik, many thanks for joining us. Sajith, let me start by asking you, between the last report of 2023 and this report, I want to ask you, what has been the big revelation that the data has thrown up for you, Sajith?
Yeah, I think it has to do with playbooks. You covered exhaustively the report. I would say on the macro front, not much has changed. The households, the 30 million households remain, pretty much where they are. They've got richer, but I would say that on the macro front, not as much has changed. But what we're really seeing is, I think, on, I would say, the playbooks front, I think there's been a sharpening of the playbooks by Indian startups. UPI AutoPay in particular has been a revelation. And I think startups have started using that to a far greater degree. They've started leveraging some of the DPI infrastructure, digital public infrastructure. Namayatri, for instance, is a great example of that. So I would say it's really on the playbooks front, Shereen, that we've really seen a distinct change and evolution.
Yeah, and I will get Karthik to build on that as well. Karthik, just build on what we heard there from Sajith in terms of the playbook building and what's interesting and what's distinct when we talk about what's happening in the Indian startup ecosystem today. And to take that further, I want to focus on what we are seeing happen on the fintech side specifically, not the regulatory headwinds, but really whether we are hitting some sort of a saturation point or a ceiling there. Because even when we talk about the payments ecosystem, everyone now trying to get a piece of the e-commerce pie. What do you see as the story there? So playbook, and then specifically what's happening on the fintech side.
Thanks, Shereen, and I agree with Sajith. I think that's the most rapid, comprehensive summarization that you did in those few minutes. But specifically to your question, I think India has been a market where you can't force shift discretionary spending at the pace that you want to fund startups. So you simply can't say, I'll give you more money, go and increase the profit pool, start growing faster. So what we've noticed consistently over the last 12, 13 years is that somebody who's in a sector tries to improve the profit pool by increasing the value chain, part of the value chain that they can grab. So it's always adjacencies. So somebody starts off as fintech and ends up in commerce. Somebody starts in commerce, ends up in fintech. Somebody starts in supply, in consumer front end like a lens cart, but ends up having to back end its entire manufacturing in the world's largest plant in Rajasthan. And so essentially the margin structures, if you want to get past those 30 million household or those, India 1, India 2 universe of 250 million, if you want to get past that, then you have to go and become even more efficient in how you deliver. And historically, the DPI infrastructure it's not new, it's been there for 6 to 8 years, but how to leverage it better and better to access those customers and reduce cost of distribution almost close to zero. That's the new regulatory playbook that we're seeing in India. So if you have to get past, India 1, India 2, you have to be able to milk the DPI plus geo infrastructure that the government and Mukesh Ambani have given us. It has at least a starting point. And I think that's evolving very rapidly, and which is why I think we build very differently from what's been considered a China playbook or a US playbook, which doesn't necessarily apply to us. Because as Sajith said in his report, there are many ways to look at the data, but you're not going to be able to grow those 30 million households fast enough. And there's enough empirical evidence to show that will go at a steady pace because discretionary spending doesn't accelerate as much as we would like it.
Yes, even though there is a lot of talk about this being the consumption decade and so on and so forth, you're absolutely right in caveating that we need to be mindful of the kind of growth we can expect as far as discretionary spends are concerned. But Sajith, back to Karthik's point there, on building or leveraging the power of the DPI, which has been work in progress for the last several years now. But, what that's doing as far as capturing adjacencies are concerned. I mean, I was talking to the gaming guys, microtransactions, in-app purchases, surging on account of microtransactions. So what are you seeing happen on account of being able to leverage DPI, leverage UPI, etc. at this point in time? How is that definitively changing playbook and opening up adjacencies?
On monetizing via microtransactions, we've seen two distinct playbooks. One would be the likes of, say, Pocket FM, for example, or a Coco, which is really looking at, I would say, very small ticket items. So maybe creating an internal wallet of coins and then allowing people to kind of use that against specific in-app purchases. So the gaming ones you mentioned, I would say Dream11 and Pocket FM, for example, would be great examples of that. On the other hand, UPI autopay, and we've seen surging mandates on UPI autopay. And UPI autopay really enables you to drive retention. So Stage, one of our portfolios, has seen about 100% of its kind of customers, new users, now come through UPI autopay. So UPI autopay is great for subscriptions. So these are two kind of distinct models that are evolving in the microtransaction space, and different startups are choosing to use either of these depending on how it fits into their product strategies. Specifically on microtransactions, this is what we're seeing. The other interesting one on DPI has been the account aggregator framework, which allows lending, and that's a very interesting story that's evolving. And in the coming year, we would see ONDC rolling out credit, and we're going to see that kind of grow on steroids. So far, it's really being used more as a sort of an onboarding play, but the complete interoperability, the way Namayatri happens for kind of getting your rights, similarly, you can actually have credit happening here. So we are seeing that as a very interesting kind of future play that's likely to emerge. Even though, and microtransactions, the playbook has really got built out this year. But on credit and the account aggregator framework, we're going to see that happen next year. So these are distinct ways in which I would say the DPI infrastructure is being leveraged.
So watch out for what happens on the account aggregator front. That's the story for 2025, and microtransactions has been the story for 2024. But Karthik, speaking of stories that are building out, and I think that's one of the interesting slides from the report on merchant media becoming bigger than print ads, because this takes me back to a conversation that I was having with Dara Kushrotrai of Uber, where he was basically talking about what this has done for their business essentially as well, opening up a new revenue stream. And that's the story that's playing out across a whole bunch of merchants at this point in time. Karthik, how do you see this as a trend?
We're all in the media business. Sajith and me, both our last day jobs were with the Times Group, as you know. So,
we're still in the media business.
No, you are, of course, Shereen. But we all know that attention is how you monetize in the media business, right? And so, what's happening very interestingly is attention is shifting to the small screen. It's shifting even more than desktops, which was how the US and the UK evolved. And it took a while for small screen, property monetization to find more innovative mechanisms. And I think that surge is beginning to happen at this juncture where, people are realizing that, I was just watching my pizza order yesterday, and the number of times I got to that brand, which is sitting on the Swiggy rider, was amazing, right? So that's all essentially an advertiser seeking. And I'm not surprised that the dollars are shifting dramatically, because the eyeballs are shifting dramatically away from traditional media. So I think people were surprised with the shift in how much internet advertising took over from like 1% market share in 2006 to some massive, I don't know the current number, maybe Sajith does, but the shift was dramatic between 2006 and 15. And now I think we're seeing a second wave of that, where you're going to find a massive multiplication of, how much of that is going to shift to mobile first, visual display advertising, which was and very creative stuff, right? Whether that's Uber or Swiggy, or whether it's Flipkart or Amazon. And this will continue because I think our attention spans are more mobile phone oriented today, and that's where the consumers are sitting, the 850 broadband connections, 850 million.
Let me just plug CNBC-TV18 is available on your mobile phones, on the app, on Instagram, on Twitter, on YouTube. So we are quite literally out of the box as well. But Sajith, coming back to you, and again, this is something that has emerged as a trend through 2023, the rise of the SME IPO. And while there are some concerns linked to the kind of frenzy that we've seen on that side, but you asked the question, is this the new growth round? Is it?
Well, it was rhetorically, and I would say that for a large number of startups which have access to funding, I don't think this is the growth round. But I would say that there are a certain number of startups which do find it hard to kind of access the kind of capital that, say, Lenskart would be able to raise. So in that context, when you're finding it very hard to raise a large round, or you're not loved as much, this becomes a very powerful way. And if you look at it, Shereen, the amount of money raised last year in the SME IPO was 10% of the main bourse. So it's rising. And if in the last 5 years, if you actually look at it, the SME IPOs, yes, clearly it's been a buoyant last 5 years, and they've benefited from the liquidity that's awash. But they've really been able to deliver much better than the main bourse IPO. So in all likelihood, we find that the receptivity to a company, that's typically if it's a startup or even if it's a slightly old school play, we are likely to see far better receptivity. And there's a deepening of the SME IPO, barring, of course, anything untoward that's happening. And if the liquidity was to continue, we would see this growing. It's not for everyone, but for a certain kind of, I would say, startup, this would be a very, very attractive way to kind of list and get liquidity for itself. Yeah.
Well, speaking of receptivity and listing, Karthik, let's extend that to the main board now. And, we do have a pipeline of celebrated names looking at IPOing through 2024. But given where the markets find themselves, as well as where the large Indian startups find themselves and the sort of surround sound at this point in time, how do you see that impacting confidence and receptivity?
I think if I were the regulator, and it seems quite clear from some recent actions, I think they're a little wary after that first mini boom that happened in 21, followed by a little bit of a suppression of that market. In fact, that would be an understatement, right? A lot of them got plundered by the market for brief moments of time until they actually had to prove their worth in the public eye, in public domain. So Zomato's comeback story is fantastic. The policy are turning profitable. Nykaa is almost back. So the stories, I think, are giving confidence, but I think regulators vary about what they let out in the large caps per se. These are all large caps, right? Anybody is a unicorn, and little more than a unicorn in India becomes, late mid cap, large cap. And so there, I think there's going to be more scrutiny, I would argue, and you can see some big pullback as well. But if everything is clean and you have a shot at being profitable and it's not a messy cap table or balance sheet, I think there's no better time in some sense. Of course, market vagaries will continue pre-elections, post-elections. But if the solidity of the business is there, I feel I've always maintained, I might change my view 3, 4, 5 years from now, but I feel there's such a short supply of good technology stocks in the market that the market is waiting to induce them into more and more portfolios, right? Induct them into more portfolios. So basically, that opportunity exists for whoever wants to take lead in any space. These are all, market leaders in their spaces because there's nobody else who's public in that space. So recently, I found myself quizzing the two big edtech ones, Upgrad and Eruditus. One of them is thinking of moving back to India, and they still feel 2-3 years away from their public issuance at the least, right? I was telling them, please hurry, because then everybody can peg their valuations to you guys, because you're the leaders in the market, and we need to see that for a chain reaction to begin. And I feel that's, the analysts in the public market need to understand these business models, not one by one, but en masse. So I feel that's the main boss piece. And on the SMB piece, I feel, just to add to what Sajith said, the one risk is that in India, the SMB market is also sensitive to a borderline profitability or a path to profitability. So it's not for most venture funds, venture-backed companies which have not figured out how to turn profitable. Ironically, as a main boss company, you can actually go public if your business model is well understood, you're a market leader, and you're actually on a path to profitability. Today, the analyst universe understands that you're the best in class and they will actually back you in the markets. That is much tougher in the SMB market. So the SMB market is more, relevant for someone whose profitability / size is considered a little less attractive to the venture market, but yet can actually go and continue being profitable for 5 years or 10 years after they go public. Yeah. So the two that went from our portfolio are seeing the benefits of that. Whereas in the large markets, I think you want to be a category leader or a category number 2 that can be pegged to a category 1 in the public markets for you to be a great outcome and a great, show after you list. So a lot of demand, in my view, just a matter of time, not if, but when all of these will list and create a very vibrant tech sector index in public markets.
Well, we'll have to wait to see how that plays itself out. But speaking of indexing, and Sajith, I want to come back to you because this has been a perennial challenge in India, the fact that we continue to be under-indexed on R&D spends, on innovation. As you look at the playbook building out, and you said that, it is going to be distinct for India, I mean, how much of this is going to be driven by innovation? How much of this is going to be driven by R&D and the moats that one can build on account of that? What do you see on that front at this point in time? Because we really haven't seen much change, even as far as the large companies are concerned, when we talk about spending on R&D.
Yeah, that was an interesting finding when we looked at the data and found that Indian private companies underinvest in R&D, and a lot of the lower numbers actually come from the private sector underinvesting. which we've seen that in the gross fixed capital formation side as well. And it's actually fascinating how that parallel kind of plays itself out. There's only so much that the government can do to kind of drive that. And in our view, you won't get the next wave of highly innovative companies if you don't invest in basic research. Given the challenges around Indian academia, the research that's coming out of it, we feel that aren't enough institutions and Indian startups and Indian corporates will have to kind of invest. And until that happens, we're going to see very limited sectors in which space is one we are really seeing a fair amount of activity. And no doubt about that, a lot to do with how ISRO has supported the growth of the sector. But barring that, we haven't seen too many other sectors. Perhaps we'll see this in the coming few years. We haven't seen that. So to your point, yes, I would say that the intellectual property is an area where I think we could do far more. And I don't think we have seen that yet. And it's primarily led by private sector under-investing to a significant degree.
Karthik, the two trends that we've, of course, seen gather momentum and steam, the rise of digital native brands, and the share is up at 44% in 2022 versus 25% in 2018. And the rise of quick commerce emerging as a key channel for digital native brands and moving beyond the sort of necessities which was the playbook when they started with. How do you see the possibilities emerge, the opportunities emerge for both these spaces over the next few years?
I think we've been believers and observers of this, which Sajith's articulated well, but we've also been believers. We're also backing companies. I don't know where Dunzo will end up, but we were first backers of the space. But essentially, if you look at the real long game in India, you have to buy into sort of emerging consumer behavior as opposed to existing consumer behavior, right? So what I mean by that is, if you look at the urban population today that has been brought up digitally native, their inclination is to be able to do all of their discovery, sharing, purchasing, everything is mobile first, right? Or online first. And I think that trend line is kicked in 4, 5, 6 years after access costs, after brand availability and penetration and consumer behavior sort of come together. So we always believe that these things to come together take 5, 6 years. You can't switch on a button and say, I'll spend a lot in 2017 and everything should have fallen in place. There's a time and a place for it, and I think it's beginning to happen. And the pandemic definitely helped in driving some of those accelerations of behaviors. I would argue if the pandemic hadn't happened, we would be still 2 years behind or 3 years behind. So I think some of these have been driven by just incredible ease of access and a predominantly online purchase behavior, accelerated by sort of the last 3-4 years of both external circumstances and how India's youth is essentially driving a lot of this. So the spending power with that particular segment of customers drives both those trends, quick commerce and digitally native brands, if you ask me. It's not necessarily you and me necessarily shifting all our purchasing to that format. Because we've experienced a certain type of commerce and we're very familiar with our spending power in a different model of commerce. And I think the surging youth consumption is basically driving this, in my humble opinion.
Sajith, I want to end by asking you about what the story looks like as far as venture funding is concerned, because we've seen a significant deceleration. In fact, we're down to about pre-2017 levels. What could trigger the return of venture?
Yeah, I feel some of the tide is turning. Looked at the Feb numbers and they're at 900 million. And so if you look at that kind of a run rate, we should start seeing it cross about 11, 12 billion. In my mind, I think a lot of it has been to do with growth. And if you actually look at the slide after this, which you're presenting, Growth's really, and if you tease it apart into early stage and growth, you would find that growth's really been the big sharp fall, and a lot of it is led by really growth. And growth's been sitting on the sidelines, primarily due to the fact that the stock market gave a lot of these stocks a beating. Fact that many of the multiple benchmarks that comparison in the public market's been very low. So they're saying that, hey, if that is so low, then how can we give a high valuation here, which is fair. But as the market kind of lifts itself up, and as growth starts seeing more compelling stories, they will start wading in. And I feel the Indian market should certainly go up from where it was last year. And a lot of it will be led by growth happening. When I say growth, it's both early growth as well as late growth. And while it won't be as buoyant as 2021, that was an extraordinary period. We will see some of the energy coming back, though it won't be as much animal spirits. So I would say, Shereen, I would certainly see it, going back into say $12 to $14 billion. That's my view. Will it be as high as what it was? No, maybe not. But fundamentally, it's led by the fact that growth investors have been very, very cautious, and they now want to invest only in really good ones, good companies. Yeah.
Well, we will wait to see the return of animal spirits, if at all, through 2024 or post that. But Sajith and Karthik, we can't do justice to all the wonderful nuggets that the report highlights. We hope we've done a little bit, but we will, of course, continue to track this and continue to talk to the two of you on the many trends that have emerged and what it means for India's startup ecosystem. But as always, many thanks for joining us here on this special edition of Young Turks. Karthik Reddy, Sajith Pai, thanks very much. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.